My investing strategy is very simple. I look for the highest quality businesses in the world and hold these businesses for extended periods of time. I own companies that could be described as compounding machines, companies that have the strongest management teams, the best capital allocation, businesses that have growing earnings and free cash flows, and stocks that could only be described as the best in the market. And I make no exceptions to find high quality businesses. With that said, I want to introduce you to my newest addition to this portfolio. I just bought $3,500 of this stock called MELI, or Mercado Libre. Now, it's very unlikely I make changes to my portfolio. I run a very concentrated portfolio with only 9 total positions. Seeing a purchase of a new stock in my portfolio means the business is outstanding. Let me give you a bit of a rundown on what MELI does. MELI is the leading online marketplace and fintech platform in Latin America. MELI is the equivalent to Amazon in Latin America. They have a strong moat and brand recognition in their sector, and they're also the leading platform and are growing exponentially. So MELI currently operates in 3 main sectors: e-commerce, logistics, and fintech. E-commerce and logistics make up around 59% of revenue, and fintech makes up 41%. Taking a look below at this image, you could actually see a representation of where all the revenue is coming from. So you could see that Mercado Libre, the main revenue stream, actually makes up the majority of the revenue, but you also have their fintech and logistics sectors. So you have Mercado Envios, Mercado Pago, Mercado Credito. So these 2 last ones are actually their fintech sectors, and Mercado Envios is actually part of their e-commerce and logistics business. So all around, this business is extremely diversified, and you can see that they have very diversified revenue streams through each sector. Now, if we look a bit closely, you could actually see that the fintech revenue has actually been compounding faster than their e-commerce revenue, which I find very interesting. So although fintech is a smaller sector of Mercado Libre, it's actually growing faster than their main sector, which is e-commerce. So if we look at their compound annual growth rates, you could actually see that fintech revenue has a compound annual growth rate currently of 43%. But if you look at commerce revenue, you could see it has a compound annual growth rate of 37%. Fintech revenue has actually been accelerating recently. So the fintech sector of Mercado Libre is not only smaller, but it's also growing exponentially. So this means that down the line, Mercado Libre's fintech sector will actually make up a bigger portion of their revenues. This is a big deal because fintech tends to have significantly higher profit margins than e-commerce. And we all know companies like Amazon and e-commerce have very low margins. They don't have the highest margins in these sectors. But if you look at fintech, a lot of fintech companies actually have extremely high margins. So it's always good to see strength in this sector. Just a side note, in the middle of recording this video, I actually upgraded my camera setup and I actually invested heavily into my YouTube setup to make stock market videos. And I hope these upgrades improve the quality going forward. So all that to say, Mercado Libre's fintech revenue is growing extremely fast. But what I want to point out is if you actually look at quarter over quarter how much the revenue grew, Mercado Libre's fintech revenue grew 9.22%. And now if we go to one of Mercado Libre's competitors, which is NU Holdings, which is a digital bank and fintech platform in Latin America too, you look at their growth over quarter and you can actually see that it's a measly 2.4%. So what that means is Mercado Libre's fintech platform is actually growing quarter over quarter most recently faster than their competitor, which is NU Holdings. So you have a 2.4% growth rate, and then you have that compared to a 9% growth rate. So that means somehow Mercado Libre is most likely taking market share and taking customers from NU Holdings, which is very good to see and shows that they have some sort of competitive advantage in this sector. To conclude, what I'm saying about this company is that it's basically the Amazon of Latin America. It's growing faster than Amazon, and it's reinvesting their capital at extremely good rates. So let's dive a bit deeper into the fundamentals. When it comes to each company I invest in, I always like to look at a certain few key metrics. Every company I own has significant growth in their revenues. I like to own compounding machines, which are businesses that compound over time and grow exponentially over decades, and Mercado Libre is no exception. As you can see here, the revenues have just exploded recently, and they actually have been accelerating over the past few years, which is always very nice to see. Looking into the shares outstanding, you could see that Mercado Libre is not actually doing buybacks. That's to be expected since this company is investing heavily into growth, but down the line, I would like to see them do some buybacks if the share price drops below its intrinsic value. The return on equity is quite high at almost 50% recently, which is quite good. Looking at the return on invested capital, which is a metric I always like to use, it's at a 14 to 15%, which is not all that bad. What I mentioned before, and I'm going to mention again, is that it's actually very hard to evaluate this company based on certain metrics. As you can see here, if you look at net profit margin, the metric just doesn't work because this company is investing so much into CapEx. And it's investing so much into growth that it becomes a very difficult process of evaluating if the company is extremely profitable or not, because this company is not actually taking profits at this moment. Just like Amazon, this company is waiting for down the line to become extremely profitable, and currently they are just focusing on the long term and investing heavily for the future. So what you're going to notice is the margins are actually going to be lower and even negative sometimes, and that's to be expected. To give you a better example, if we take Melli's current PE ratio, which is 61%, you may look at this and think, wow, this company is extremely expensive. Why would I be paying a 60 PE ratio when I could go out and buy Amazon at like a 30 or 40 PE ratio? But that's not the whole story, because Mercado Libre right now has a net margin of around 7%. And with a net margin of around 7%, this company may seem like it's not earning much per share, and that's why the PE ratio is extremely high, because they just have a low margin. But what I think will happen is Mercado Libre will actually increase their margin down the line significantly. I could see a net margin of around 20% down the line if they continue in fintech and they continue expanding and they continue growing in cloud and fintech and all these financial sectors. I could easily see them have a margin of around 20%. But then this is where it gets interesting, because if Mercado Libre has a net margin of around 20%, then the PE ratio at this moment is significantly lower. It's around a 25 PE ratio. And that's a big difference. So you're paying a 25 PE ratio for a company that's growing exponentially, and that's growing over 20% on the year. So you have to be forward looking when looking into these businesses. The last metric I'm going to show you is arguably one of my most important metrics, and it's the free cash flow. So you want businesses that grow their free cash flow year over year, and that just shows that they are very profitable and they are earning a lot of return on invested capital and return on equity from their investments. So as I keep mentioning, Mercado Libre is not exactly at the point where it has a significantly high margin, but they are generating some significant free cash flow. So currently the free cash flow is at around 6 billion. So that's very good to see. To give a summary of all the metrics I just spoke about, this is what I came to in conclusion. So we have a company that has extremely good growth. This company is growing at around 37% year over year currently, and that's insane for such a large company. We also have good return on invested capital and return on equity, which is a metric I like to use to see if their investments are actually doing well. Let me give you an example. If you have a management team that you give $1 to and they return 80 cents on that dollar, they are destroying value. This company is a value destroying company. But when you have a company where you give them $1, you give the management $1, and they return to you $1.20 in the next year, that's a very good company. That's a company that returned you 20% on your investment. So this is what you want to see in companies. You want to see companies that have a return on invested capital that is significantly high. Mercado Libre checks those boxes. So that means that their capex and what they're investing in is generating them a significant return on invested capital. And this ties into good capital allocation. So it means that the management understands what they're doing. The management understands what the investors want, and the management is investing accordingly. And the management is also understanding that they need to earn shareholder value and generate shareholder value. And I put down strong management because all the metrics seem to be good. They're not significantly diluting shareholders. There's no funny business going on. They don't have extreme amounts of debt, although they do have some because they're expanding significantly. But all around, fundamentally, it's a very strong company. And that's exactly the reason why I bought it. So now I'm going to emphasize on the moat of Mercado Libre. So I always buy a company that has a moat, and it's a mandatory obligation for me to own companies with a moat, because without a moat, a company could be taken over to competition, and that creates serious problems. Companies without moats have significantly lower margins, and they don't have any growth drivers because they're being taken over by competition. So it's very unlikely you have a compounding machine that is not a company with a moat. All that to say, Mercado Libre has a significant advantage and competitive advantage against its peers. So as I mentioned earlier in the video, Mercado Libre is actually growing faster in fintech than its competitor, which is NU Holdings. So NU Holdings is a digital banking platform, and it only grew around 3% quarter over quarter. When you compare that to Mercado Libre's fintech platform, which grew around 9% quarter over quarter, the growth of Melli compared to NU, which is a key competitor, pretty much shows that this company has a significant competitive advantage. Obviously, Mercado Libre is dominating the Latin and e-commerce market. I pulled up a few statistics here. So 55.6% of share in the digital media advertising market is actually owned by Mercado Libre. So they earn revenue on that percentage of share, and that share is going to continuously increase and grow over time, what you want to see in a business you own. So the total amount of e-commerce sales in Latin America was around 20 to 25% through Melli, which may seem like a small number at first, but what you have to understand is that in Latin America, it's not like in America. Because in America, everyone has a digital bank account and everyone could just buy on Amazon. But in Latin America, it's significantly different because the majority of the population just does not have digital bank accounts. You have around 70% of the population that has a bank account, but the other 20-30% don't have digital bank accounts. So they have 20 to 25% of the e-commerce market that doesn't make up the entirety of the population. And this is statistics from 2023, which it's been a while since then. I don't have the statistics for 2025 because I literally searched everywhere and I could not find them, but I assume that that number is going to be a bit higher. And what adds to the competitive advantage of Meli is the tailwinds fueling its growth. So in 2023, 178 million people in Latin America were unbanked. And this goes back to what I was just mentioning, is that approximately 30 to 35% of the adult population don't have digital bank accounts. So going forward, this percentage of population is going to start getting digital bank accounts, and they're most likely going to go to the best platform, which is going to be Meli. What that does is it creates a new customer in the digital banking platform, but it also gives them access to the e-commerce market. So that's two drivers that are fueling growth. I'm not going to do a deep dive into the earnings call because it pretty much summarizes everything I've been saying so far. The company is growing exponentially and the company is seeing outstanding growth in the majority of sectors. I'm going to just read you a couple things that I think are very important. The first one being is that they said the company is focused on solidifying its position as the leading online destination in Latin America and democratizing financial services in the region. Argentina's exceptional performance, fueled by microeconomic stabilization and the strength of Mercado Libre's brand, significantly contributed to the overall positive results. The company is reinvesting in key areas like credit cards in Brazil and Mexico to capture long-term growth opportunities. So this is a very long way of just saying that management is focusing on the long term. And this is a point I've been reiterating this whole video, is that the management is very long-term focused. It's exactly like Jeff Bezos at the start of Amazon. If you read Jeff Bezos' Amazon reports in the beginning when he founded the company and when he went public, you can actually see that this man had a very clear goal. He wanted to expand internationally. He wanted to fuel growth. He wanted to have one of the biggest companies in the world. And I think this company has a very similar strategy. As I was recording this video, there was some very important news that just came out, and I'm going to read it to you right now. The CEO of Mercado Libre is actually stepping down from CEO position. Now, he's still going to be within the company, but he's actually being replaced. So he's being replaced by someone named Ariel. I'm not even going to try to pronounce his last name, but he has been an executive at the company since 2017, and he'll become Mercado Libre's new CEO as of January 1st, 2026. As this news came out, the stock dropped around 4%. Now, I personally don't see this as necessarily bad news because, as Warren Buffett said, it doesn't necessarily matter who runs the company. What matters is that if the business is high quality and if the business is able to be ran by an idiot, as Warren Buffett would say. Now, I'm not saying the new CEO is an idiot by any means. I'm just saying that if the company is very high quality, it's very easy to run a company that's high quality because you don't have to do much. It just continues generating revenue, you reinvest properly, and the company grows over time. So hopefully this new CEO can do a very good job at running this company, and I see no concern or no reason to panic at all. Last but not least, we get the valuation. Many investors might be quite shocked that Meli is actually trading at a PE ratio of 63% approximately at this moment. And when it comes to valuation, I reiterate this point so many times in all my videos. It really depends on what your expected growth rates are and what metrics you are using, because you can't use the same valuation metrics for all companies. Some companies reinvest heavily, so it's very difficult to calculate what their profit potential is. And some companies have insane amounts of free cash flow, so you have to base your valuation based off that free cash flow. And some companies, you can't even use a PE ratio because they work in the financial sector. So there's many things you have to consider when it comes to valuation, but I'm going to give my honest opinion on if I think Meli is overvalued at this moment or not. So to start off, we have a PE ratio of 63. Now, I actually let AI do the heavy lifting for this one because I just want to reiterate my point and explain what I think of this company as right now. I asked the AI, if Meli stock had a current net profit margin of 20%, what would be its current PE ratio? Now, the reason I hypothesized the net profit margin of 20% is because I feel like down the line, if Meli decided to focus on profitability, they could earn a net profit margin of 20%. So what AI did is just calculate Meli's current share price and all its profitability metrics and hypothesized if it had a net profit margin of 20%. And what we got here is, I'm just going to scroll down, and we got a result of a PE ratio of 26.53%. So currently, if Meli focused on profitability and not growth, we would have a PE ratio of 26.53%. Now, hypothetically, we are paying a PE ratio of 26.53% for a business that is technically growing at 37% year over year. And I always seen that as a very fair price for this business. Now, it's nowhere near what it was a couple months ago when it was down to $1,600 to $700 a share, but I still believe Meli is trading at a slight discount, and that's the reason why I put $3,500 into this stock. If I see any more major or significant dips in this company, I would definitely be buying a lot more shares. There's also some factors factors that you need to consider in your evaluation, but they aren't in the numbers. For example, a bunch of tailwinds that are benefiting Meli in Latin America cannot be physically shown in the actual numbers itself. The amount of people that are switching to online banking is not something you can really calculate in your valuation metrics. It's not something that shows in the numbers. All that I can see is just exponential growth in the sector, and that's what we have been seeing with Meli, and we have been seeing Meli take market share. So I could hypothesize all I want. I could hypothesize a 20% growth rate year over year. I could hypothesize a 15% growth rate and then see what happens over the next 10 years. So from a logical standpoint, you have a sector that is significantly growing, has a bunch of tailwinds benefiting it, and all around seems to have very solid growth drivers over the next couple of decades. And for that reason, I saw Meli at a relatively attractive valuation in my opinion, and I bought into it. But it really makes no sense to do a full fundamental analysis on evaluation if someone's just going to watch this video and have a different opinion or have a different view of what metric to use or what to evaluate the company on. I personally think that depending on the profitability of the business and how they reinvest their capital, this company may seem significantly undervalued with around a 25 to 28 P ratio. But that just depends on my opinion and what I think the profitability would be of this company. If you as an investor think that Meli will not become significantly profitable and only have a margin of around 10 to 12%, then your evaluation will be significantly different. You might even see this company as overvalued at this moment. And that'll be all for today. I have the referral links to all these platforms I used in this video in the description below. And I hope everyone enjoyed this video. Have a good day.